The bank uses one number to decide if you qualify, and most first-time buyers have no idea what it is or how to fix it. In fact, a high debt-to-income ratio can cost you $10,000 more in mortgage payments over the life of the loan. This video is for first-time home buyers who want to understand how to qualify for a mortgage. You'll learn what a debt-to-income ratio is, how to calculate it, and how to lower it to get approved for a mortgage. Specifically, you'll learn what a debt-to-income ratio is, how to calculate your debt-to-income ratio, and how to lower it to get approved for a mortgage. What is a debt-to-income ratio? A debt-to-income ratio is a percentage that represents the amount of your monthly gross income that goes towards paying off debt. For example, if you earn $5,000 per month and your monthly debt payments are $2,000, your debt-to-income ratio would be 40%, $2,000/$5,000. Lenders use this ratio to determine whether you can afford to take on more debt, such as a mortgage. How to calculate debt-to-income ratio? To calculate your debt-to-income ratio, you'll need to add up all of your monthly debt payments, including credit cards, student loans, car loans, and any other debt obligations. Then, divide that number by your monthly gross income. For example, if your monthly debt payments are $2,500 and your monthly gross income is $6,000, your debt-to-income ratio would be 41.67%, $2,500/$6,000. DTI limit for conventional loans. The debt-to-income ratio limit for conventional loans is typically 43%. However, some lenders may have stricter requirements, such as a 36% debt-to-income ratio. For example, if you're applying for a conventional loan with a lender that has a 36% debt-to-income ratio limit and your monthly debt payments are $2,000, your monthly gross income would need to be at least $5,556, $2,000/0.36, to qualify. DTI limit for FHA loans 2026. The debt-to-income ratio limit for FHA loans in 2026 is 43%. However, the FHA also has a front-end ratio limit of 31%, which represents the percentage of your monthly gross income that goes towards paying your mortgage, property taxes, and insurance. For example, if your monthly gross income is $5,000, your front-end ratio would need to be 31% or less to qualify for an FHA loan, which would be $1,550, $5,000 x 0.31. How to lower your debt-to-income ratio? To lower your debt-to-income ratio, you can try to reduce your monthly debt payments by paying off high-interest debt, such as credit cards, or by consolidating your debt into a lower-interest loan. You can also try to increase your monthly gross income by taking on a side job or asking for a raise at work. For example, if you're able to reduce your monthly debt payments by $500, and your monthly gross income remains the same, your debt-to-income ratio would decrease by 10%, $500/$5,000. Tips to get approved for a mortgage with a high debt-to-income ratio. If you have a high debt-to-income ratio, you may still be able to get approved for a mortgage by making a larger down payment, which can reduce the amount of debt you need to take on. You can also try to find a lender that offers more lenient debt-to-income ratio requirements, such as a lender that allows a 50% debt-to-income ratio. For example, if you're able to make a 20% down payment on a $200,000 home, your mortgage payments would be lower, which could help to offset a higher debt-to-income ratio. If you're ready to start the mortgage qualification process, click the link in the description below to download our free mortgage calculator and get started on your path to homeownership. Don't forget to subscribe to our channel for more first home buyer tips and tricks.